Hate to be the bearer of bad news, but if you're expecting a loss on a job, you have to recognize that entire loss when you determine that job is going to lose money. So according to GAAP, you can't recognize a percentage of the loss as you would recognize a percentage of the profit. So I've highlighted a footnote related to this, and this footnote is based on GAAP financials. I've included the link above, and I'll also put it in the description box, but we'll just read over this real quick. If at any time the contract estimates indicate an anticipated loss on a contract, the projected loss is recognized in full, including the reversal of any previously recognized profit, and in the period it is identified. What that means is if you're expecting a loss of $50,000, you have to recognize that entire loss in the year you determine it's going to be a loss. So $50,000 loss this year is what you're expecting, say 2 years down the line. You have to recognize that entire $50,000 loss in the current year. You can't postpone that loss to a future period. You know what my default answer is going to be? The best way to demonstrate all of this is to look at the WIP template. In front of us, we have the WIP template, standard WIP schedule. We're going to break it down by year. So the first year, our contract amount is $100,000. Our total estimated cost is $60,000. We've got a gross profit of $40,000. We come to our activity for the year, and we're about 51% complete. So based off this model, we're going to recognize roughly half of this $40,000, which we see over here, about $20,000 in gross profit. Fast forward to year 2, job goes south. We can't recover some of the costs. We anticipate a significant loss. So $40,000 loss now. Well, you can't look at the percent complete for this year, which is 37, and say, okay, I'm going to take 37% of that $40,000 and recognize it as a loss for this year. You have to recognize the entire loss when it's identified. So by year 2, we recognize the entire loss. As you come over to this section, you'll see revenues earned is negative $38,667. Cost to date, current year cost $22,000. Okay, that's factoring in all this prior year activity. You see prior year revenues earned, prior year cost to date. This $51,000 was the revenue we recognized last year. And this cost to date was what was through last year. So current year cost of $22,000. We have negative revenues earned. Why? Because we're recognizing the entire loss this year. There's a huge overbilling. As you remember, overbillings reduce your revenue and increase a liability. So with that huge overbilling, we're reducing our revenue to the point where we're at negative $60,667 in gross profit. You say, wait a second, I thought we were supposed to recognize a $40,000 loss, not $60,667. Well, when you combine the prior year gross profit with the current year gross profit recognized, that's negative $40,000. So we're essentially backing out all of the prior year revenue because we know now that we shouldn't have done that. It was a loss. So you recognize it all up front, which what ends up happening is you undo the prior years, and it's all recognized up front. So through year 2, we have a gross profit of negative $40,000. Year 3 rolls around, and we have the contract price at $100,000, and the total estimated cost remains at $140,000. Bill to date obviously matches the contract amount. Cost to date matches total estimated cost. The job is complete. When you run your current year revenues earned and costs, you'll see that they flush out because we've already recognized that $40,000 loss. So anything after that should just be a wash. So we see here again, that's a $40,000 loss. $87,000 in revenues earned minus 87,000 in costs, that's zero gross profit. How we get there is by backing out, again, the prior year revenues and prior year costs. I hope that all made sense. If not, leave a comment below and we can talk about it further. Thanks again for tuning in. I'll see you in the next lesson.